The largest floods, locusts, and epidemics in the CCP's reign have caused more Chinese citizens to carry more debts. Including loans outside of the banking system, such as P2P online loans and housing provident funds, the actual debt-to-asset ratio of Chinese residents in the first half of this year may exceed 82%. High debts inhibits consumption and risks capital chain rupture, in other words, money shortage in society. According to the statistics of China's central bank, as of the first half of 2020, the total debt balance of the Chinese household sector reached 58.9 trillion yuan. That's $8.4 trillion. And the household debt to GDP ratio is nearly 60%. This is similar to an IMF report. The International Monetary Fund also predicts that China's household debt to GDP ratio will increase rapidly year by year and will climb to 67.9% by 2024. According to estimates by the Southwest University finance team, if loans from non-bank institutions such as P2P online loans and housing provident funds are included, the actual debt amount of Chinese residents is 1.4 times of loans from the banking system. According to this formula, as of the first half of 2020, debt scale of Chinese residents may reach 82.46 trillion yuan. That's $11.8 trillion, with a household debt to GDP ratio of 82.5%. In fact, it is not easy for Chinese residents to obtain bank loans. In 2019, China's urban household credit participation rate was only 56.5%. If the farmers are included, the participation rate will be lower and the unstated hidden debts will be higher. In addition, according to the statistics of the Bank for International Settlements, or BIS, the leverage ratio of Chinese residents in 2019 was 54.6%. The leverage ratio of Chinese residents recorded in 2008 was 17.9%. The increase from 2008 to 2019 is 37%. Tao Dong, a senior consultant with Credit Suisse, believes that the key to China's resident debt ratio problem is too much excessive leverage at too soon of a time. Tan Xiaofen, deputy dean of the School of Finance at China's Central University of Finance and Economics, says that China's household sector loans are mainly consumer loans, accounting for nearly 80%, while operating loans of investment and development nature account for only 20%. As of the end of 2019, the official statistics of household loan balances were 55.4 trillion yuan. Consumer loans accounted for 44 trillion yuan. Medium and long-term loans were 34 trillion yuan, of which home equity loans were 29.8 trillion yuan, which accounts for about 54% of total household loans. Tao Dong analyzes that proper debt is conducive to stimulating consumption, but if a country's debt is dominated by home equity loans, if the housing market oscillates, the chain reaction is difficult to estimate and may even trigger systemic risks. Wang Jian, a senior media person in finance and economics, said that Chinese people's dispensable income is limited and a large amount of debt will suppress consumption. In addition, the rapid growth of household debts has coincided with the economic downturn, unemployment, and wage cuts. This results in a high risk of capital chain rupture.